All right, let's get started today. So, welcome everyone. Today we're going to go through the event Investment Banking with Mr. David Willard. He's here today, so thank you, Mr. Willard, for joining us. So this is a Streetfins guest speaker event. So without further ado, let's get started. So, like I mentioned before, this guest speaker event is brought to you by Streetfins. So Streetfins is an organization dedicated to solving financial illiteracy, mostly among high schoolers, right? It's a huge problem that's plaguing the whole country, the whole world, in fact. So we're trying to do our part to kind of solve this and make sure everybody has a bit more knowledge about these topics. And so that's why we have all these events and our resources. So speaking of resources, you should check us out at streetfins.com, at streetfins on Instagram, and the Finance Simplified podcast, wherever you listen to your favorite podcasts, right? So whether that be Spotify, Apple Music, pretty much anywhere, just search up Finance Simplified and you'll find us, right? So all these three things are great places to learn more about finance and just explore more about the organization as well. And also, if you haven't already, I'm pretty sure you guys have, but if you haven't already, make sure to join our Discord, tinyurl.com/streetfins-club connect. And that's basically a Discord with, I'd say it's a community of around 200 people who are all very interested in stocks. And, we have a bunch of lively discussions there pretty much every day. It's just a great community, so please make sure to join if you aren't there already. So, in that case, let's get started with our questions. Mr. Willard, would you like to introduce yourself?
Well, thank you very much, Rahul, and it's a pleasure to meet all of you. Thank you so much for this great opportunity to talk to all of you about a bit of my career in investment banking and topics around the profession. It's really just a pleasure. I think what Streetfins is doing is really exceptional and serving a wonderful cause and need in the marketplace. Financial illiteracy, as Rahul correctly pointed out, is a serious issue facing the country and other countries, and so it's important to have these types of interactions to talk about topics in the profession, career paths in the profession, and so I hope that I can make this interactive and get to all of your questions and have it be fun.
Yeah, definitely. So I guess we'll just get started with our first basic question, right? What exactly is investment banking?
Sure. Well, gosh, that's a big question, and I will tell you it's a wonderful profession if you put the time and effort into investment banking. I run a boutique investment bank, a boutique meaning a smaller investment banking firm in Silicon Valley, 52 capital partners. So I am deeply immersed in the profession of investment banking. Earlier in my career, I was at Goldman Sachs, so started my career in investment banking. And investment banking is the business in which advisors will provide strategic and business advice to institutions, governments, and individuals in connection with all manner of corporate transactions. Typically, investment banking revolves around advisors underwriting stocks and bonds and helping with financing offerings for governments and companies. Investment bankers can also perform the function of serving as a mergers and acquisition advisor, so advising both buyers and sellers on transactions that involve the merger or acquisition of assets or businesses. Those are the two kind of principal functions of investment banking. It's a profession that involves fundamentally a lot of rigorous financial analysis, and by that I mean digging into the income statement, balance sheet, cash flow statement of companies to understand their financial performance and also their financial prospects, how they are anticipated to perform over time. And then on that basis, structuring deals on the capital raise side or an M&A deal, structuring deals that allow for maximum value for the issuer in the case of a financing, or the acquirer who's looking to, say, buy a business and achieve an accretive transaction or valuable transaction in the process. So fundamentally, it's a quantitative heavy, numbers heavy profession that involves the provision of advice, giving advice to companies and governments and individuals that need it to solve their transaction needs, and that's what the industry involves. It's a really wonderful profession that can be intellectually stimulating as well as financially rewarding for those who really spend time at it and become dedicated to the profession. And I've been fortunate to spend a lot of my career in investment banking. So it's a great first question, Roy. Well, thanks for asking.
Yeah, so building off of that, we talked about what it kind of is in broad terms. How did you discover your interest in this field?
Sure. Well, I had a bit of a circuitous route to investment banking. I was not a finance major in university. So I went to high school in St. Louis, grew up in Missouri, and went to Princeton for college. And at Princeton, I majored in East Asian studies with a focus on China and Chinese history and US-China relations, but not so much on finance. I didn't have a minor in finance. I didn't pursue finance in a really serious way in terms of a concentration at school. And so I'm kind of an anomaly in that sense, in that I didn't have this kind of burning passion as an undergrad to pursue a career in finance. But I will tell you, my experience working, living, and studying in China on study abroad programs really opened my eyes to the economic growth of China, the path of China as a big global economy, and that started to pique my interest in topics of investment banking and finance and economics. And so it was through my interest in China, incidentally, that I developed an interest in economics and finance and globalization and how economies interact with each other. And so I came back from China. I was in China for about a year and a half. As an undergrad, I studied at Tsinghua University and Beijing Normal University. Spent about a year and a half in China. Got back to the States, and it was my senior year at Princeton. I was like, "Gosh, what am I going to do after college? Consulting? Do I go to a big company? Do I work at a nonprofit? Maybe do Teach for America, something like that?" And my experience in China, as I mentioned, really opened my eyes to a big global economy and all of the different themes that come with that. And so I thought, gosh, it would be really great to work at a multinational investment bank right out of college, to have that exposure to finance early on and to see if I enjoy it. And so I ultimately chose investment banking as my first job out of college, and was hired to join Goldman Sachs in the London office. And I was really fortunate to have the opportunity to work in an international setting in Europe, working on transactions with a lot of European clients. So it was really, and then from there, I should say, that was a rewarding experience. I enjoyed it. I worked some long hours, which typically happens in your first couple of years in investment banking, but it was a rewarding experience that really opened my knowledge base up to finance topics and how investment banks serve clients on major transactions. And so I was really the interest. I think by no means did I kind of grow up as a kid in Missouri aspiring to be in investment banking. It was not like this lifelong passion. It was kind of something that evolved over time. There was not kind of an immediate epiphany that happened. It was really my evolution and interest in China that really got me into the profession.
Yeah, speaking of those long hours, it's something that we've, seen in the news a lot with these investment bankers working, 90 or 100-hour work weeks. So yeah, that's pretty interesting. So, when you hear about mergers and acquisitions, which is a huge part of investment banking, one thing you kind of also hear is
Mm.
leveraged buyout. So what exactly is that? Could you
Sure,
explain that term for
absolutely.
us?
A leveraged buyout is a type of transaction in which an acquirer will use borrowed money to finance its acquisition of a target business or asset. So you could think of leverage buyouts as sort of debt finance acquisitions of businesses or assets. You see leverage buyouts typically used in the context of the industry called private equity, which is basically pools of private capital that are then deployed into acquisitions that result in typically control stakes or full buyouts of target businesses and assets. So leverage buyouts, or LBOs, the acronym, are typically used in the private equity setting. And the LBOs, leverage buyouts, have been around for quite some time. I can't give you a specific date when the first leverage buyout was transacted, but I will tell you in the 1980s, the transaction really got a lot of use as the junk bond market started to roll out more significantly. And you started to see lots of heavily debt financed acquisitions taking place, and literature written about it, journalist media following leverage buyouts. I'd say the 90s, you still saw leverage buyouts in the 90s. It had kind of I think it kind of leveled off, it's fair to say, in the 1990s. Still was used. The 1980s was really the go-go era for LBOs. And then the LBOs had a resurgence prior to the financial crisis in 07, 08. You saw lots of private equity firms consummating large transaction where they were borrowing money, entering into these big term loan agreements, credit facilities to finance big acquisitions. The industry kind of fell off a little bit, kind of 08, 09, 2010, as the economy was starting to kind of work the system through, coming out of the financial crisis, lots of new regulations. And then LBOs since then have been heavily used in the marketplace. There's lots of private equity activity these days. Financial sponsors have raised, hundreds of billions of dollars in LP capital to consummate LBOs in the marketplace. You see a lot of activity today. So it's a commonplace type of transaction you see in private equity. Has its genesis, I would say, kind of 1980s is really when LBOs started to be used heavily, and there've been kind of an ebb and flow of the LBO industry over time since then. But it's the purpose of an LBO transaction is to really allow for higher returns for the LP and GP. You debt finance. Debt is a cheaper form of capital than equity. So you lever up deals, say 70 to 80, 90% on some of these transactions. It can really juice your returns and result in higher returns on invested capital and IRR for investors, which can be very financially rewarding for LPs that have their pools of capital being deployed. So it's a neat transaction. I've been on large LBOs in my career. I've advised lots of private equity clients to this day on LBO transactions, and they're a lot of fun to be a part of.
Awesome. So our next question is, what are some of the different reasons that a company would want to merge or acquire another company, right? So why are they so interested in kind of messing with other companies?
Well, it's a great question, and I will tell you the list of reasons for acquiring a company is quite long. I can't go through all of the litany of examples of the different strategic and financial rationales for acquiring companies, but it is a long list. Some common reasons include, strategic considerations with a lot of strategic buyers who are looking to acquire target businesses or assets. They'll say, look, we sell a certain product or service in a particular industry. A competitor of ours that we wish to acquire has a significant share of the market that, if we were able to access through an acquisition, would allow us to achieve greater market share, greater scale. And so there's often a market share component to acquiring businesses that you'll see a lot of. You also see strategic acquirers, finding target businesses offering very attractive intellectual property, or real property in transactions. The assets themselves are highly valuable and highly monetizable. So there's a view of, hey, if we could own the intellectual property or real assets of this company, oil wells, drills, capital equipment, et cetera, we can monetize that and commercialize that, which can result in high profits, high margins, and a very attractive business model long term. So that's another reason. Another reason you see in often smaller deals is talent. You'll see strategic buyers look at the personnel, the executive team and the staff of businesses and say, gosh, if we could have that human capital in our organization with all of that know-how and expertise and science and what have you, that can really help our business grow in a very significant way. And so you can see a focus on human capital acquisition really drive M&A activity. And then from the standpoint of M&A transactions from financial sponsors like private equity firms, typically the rationale for that is, as the name implies, financially driven. There is a view that by acquiring the business, a buyer can achieve greater profitability, greater margins, higher revenues, greater growth, all of the above. And so by acquiring a business, those objectives can be met and can lead to a very successful combined business. And so for financial sponsors, there's a view on, returns on invested capital, internal rate of return, and how a business will financially generate higher returns over time. That's a big consideration that you'll see more commonly with financial sponsors. There are all sorts of reasons. Often you can also see, strategic acquirers have defensive acquisitions. So they will acquire a competitor because the competitor is doing something so unique and different. They pose kind of a competitive threat to the acquirer. So there's a defensive take of, oh gosh, we need to box out this competitor. The best way of doing it is not trying to compete with them head to head. We will just buy them out, totally bring them in-house. And that way we can grow them organically within our company. We don't have to deal with them from an external competitive standpoint. All sorts of reasons go into M&A, which I will tell you, having worked with a lot of companies in my career, it's always very fascinating to see the different rationales that come to the table when acquirers are sizing up why and how to put resources into M&A. There are so many different reasons, strategic, financial, and otherwise, that come to the table, which makes it a lot of fun when you're structuring deals and working with clients and trying to strategize on how to put together the best deal for them.
Yeah, so our next question is actually exactly about that. But before we head to that, just to kind of give everybody a better understanding, recently Microsoft announced that they're going to acquire Nuance, right? So which kind of rationale would that be? Out of the examples that you gave, which one does it most fit?
Yeah, that is a strategic buyer consummating a strategic acquisition for basically the intellectual property and technology of the target business. That is a classic example where there is a target company that has developed something very proprietary and high value in terms of intellectual property and software assets, technology assets that, Microsoft says, oh, look, gosh, if we could have that and bring in our sales and marketing team, our engineers and product developers, and scale this internally organically, that would be very, very accretive to Microsoft business. And so I can't say if that's a defensive transaction or just a very opportunistic deal by Microsoft, but it was an exciting one to see in the press.
Yeah, so earlier you were talking about, how a deal is structured. So how exactly does a company decide how they're going to structure the deal?
Yeah, it's a great question, and I will tell you, structuring deals is often a complex, drawn out process that involves a whole panoply of advisors and executives who come to the table to provide their input on a transaction. Typically on an M&A transaction, you will have, stakeholders like the investment banker that's, comes to the table to provide strategic and business advice. You'll have the accountants and auditors come in to review and audit the financials and look at the financial health of the company and audit the financials. You'll have lawyers come to document the transactions through purchase agreements and schedules, disclosure schedules, and other transaction documents. You'll have insurance experts. You'll have tax experts. You can have employment and benefits compensation experts all coming to the table to structure the deal and evaluate how to create a deal that maximizes the most value and allows for the best path to success. Deals are structured often with at strategic companies, the corporate development team, or sometimes M&A team, it's called, at strategic companies, is heavily staffed with typically like an SVP or VP of corporate development. They are charged with, sourcing the target acquisition, diligencing the target, reviewing all of the information and data regarding the target, and then working with the advisors. I mentioned the auditors, the bankers, the lawyers, to create a structure that allows for the best chance of success in getting a deal done, and maximizes the value for the acquirer. So what's really cool about it, I enjoy it. It's almost like a football game or a basketball or soccer game, where you have all of these different stakeholders and players working together towards a common goal of getting a deal done, and everyone is playing their different position. And what's really fun and intellectually gratifying as an investment banker is to interact with all those different stakeholders and to understand how each of them fits into the big puzzle of getting an M&A deal done in terms of structuring it and putting transactions together. So it's a very complex process, can be very complicated. When buyers and sellers start interacting, oftentimes it can be not always, but sometimes it can be a contentious negotiation with lots of back and forth and negotiation and term sheets and back and forth regarding the mechanics of the deal. And that's always fun to be a part of. So it's for those of you that are thinking about a career in investment banking, if you like, engineering and fitting puzzles together and structuring things, M&A advisory and structuring deals is a really fun thing to be a part of, because it involves almost a puzzle making endeavor, which can be really cool.
Yeah, so based off of everything you've said, it seems like acquiring or merging with another company is good for everybody involved. But, when public companies make these acquisition announcements, a lot of the time the stock of the acquirer actually falls a little bit. So why does this happen even when it's good news?
Yeah, it's a great question. It's a common feature of M&A transactions, to your point, that publicly traded acquirers will have their stock price kind of drop off, sometimes significantly, sometimes ever so slightly, and sometimes their stock price goes up. It really, there's a spectrum of outcomes that you see, but typically you'll see the stock price of a publicly traded company decline after the announcement of an acquisition. Typical reasons include, number one, the acquirer often will pay what's called a control premium to acquire the target business outright. And so by paying a control premium, a higher price than what is fair value for the company, as a means of controlling the company, that control premium requires an extra value to be paid by the acquirer. Well, the marketplace, when they see that, they go, oh gosh, they're paying a control premium. That's an additional cost or extra cost being incurred by the acquirer to do the deal. We don't like that, and so the stock price will depreciate, ever so slightly. Another common reason you'll see the stock price decline is kind of what we were talking about before, debt finance acquisitions. If an acquirer is taking on lots of debt to finance an acquisition of a target business or asset, typically when an issuer takes on more debt, the market views that as sort of a higher credit risk profile business that has a potentially higher probability of financial distress. They're taking on greater debt. They have to service that debt through higher interest payments. And so by having greater debt on the balance sheet of the acquirer, the marketplace says, oh, whoa, I don't know how we think about all of this new debt that the company is taking on to buy this target company. We don't like that. The stock price will decline ever so slightly. So those are the two common reasons. There are other reasons dealing with kind of personnel and strategic competitive reasons. If there's some regulatory elements, antitrust, CFIUS elements that can be kind of complicated in M&A transactions, you could see the stock price of the acquirer go down. But it's really the debt financing that will cause it, coupled with, as I mentioned, the control premium, that extra cost that the acquirer incurs to do a deal.
So simply put, it's how much you paid and how you paid for it.
Exactly. That's exactly right.
All right. So you mentioned your experience in, studying in China and really focusing on the Asian side of things. So, as a specialist in the Asian markets, are there any big differences between the way, the American stock market works and the Asian stock market works?
It's a great question. I will tell you, it's been an evolution over the years to see how the Asia financial markets have evolved. It's really been exciting to see countries like China, and countries in Southeast Asia mature their financial markets over time. I will tell you, my first trip to China was in 1999. I was 16. I was in high school studying Mandarin. Our Chinese class went to China, and at that time, the Chinese stock market been around for a number of years, but it was still fairly illiquid, a lot of opacity, not a lot of volume, growing in size with each new year, but not necessarily that liquid of a market. Today, fast forward 20 plus years, Asian financial markets, China included, have grown both in terms of volume and liquidity. By liquidity, I mean just the ability of buyers and sellers to quickly transact in the marketplaces, often in the secondary markets. It's a very liquid financial markets in Asia today. And but I will tell you, even with that, the U.S. today, a key differentiator is, the strength of our financial markets, the liquidity of our financial markets in the U.S. Are second to none. The U.S. is the most liquid financial market in the world. Our stock market has extraordinary amounts of volume, large amounts of transactions taking place every day across asset classes and financial markets. And so we have a very liquid market in the US. And I would say today, largely speaking, even with the progress that we've seen over the past 20, 30 years in financial markets in Asia, there's still that liquidity concern that you see, how quickly buyers and sellers can transact and exit and enter positions in Asian markets. You still have a liquidity concern that you see, and that is still something that regulators and financiers are working on in Asia to try to provide for greater liquidity in the market. The other key differentiator, I would say, between the U.S. and the Asian markets around financial markets is, the regulatory environment in the U.S. is very robust. We have lots of regulatory agencies, the SEC chiefly being, the biggest. Lots of regulatory agencies and exchanges that provide oversight of financial markets, the functioning of financial markets in the United States. There's a very robust set of administrative agencies in our government that are dedicated to providing transparency and oversight of our financial markets to ensure fairness, transparency, liquidity. And that is something that Asia today, despite the progress of the past 20, 30 years, is still frankly working on. They've made strides, absolutely, but in terms of, financial regulatory regime in Asian markets, there, I would say my assessment is they still have some progress to make to allow for greater transparency and oversight. We have just a very robust set of case law in the U.S. as well. There's lots of jurisprudence around financial markets and the functioning of financial markets in the U.S. The case law in countries like China around financial markets is less. It's a body of case law that is growing over time with just greater scale of financial markets in Asia, but the amount of case law in Asian markets, China in particular, on a relative basis is quite low. And so what's exciting for me is to see how Asian markets will continue to evolve from both a liquidity standpoint and a regulatory standpoint in the years ahead. I think there's a lot of research and effort among the investment banking community to provide for reforms to Asian financial markets, to provide for greater liquidity, transparency, oversight. And I think that's a very positive thing for the Asian markets, because ultimately those efforts benefit Asian markets, but they also benefit foreign investors, American multinationals and investors, private equity firms that transact in countries like China. If there's greater oversight and transparency, there's greater confidence in the markets when parties are coming to the table to transact. And so you can see greater liquidity, greater volume, more transactions taking place, and greater interdependence in our markets, which I would say, as a fan of globalization and open markets, is a very great thing for the Asian and American economies to aspire to in the years ahead.
Okay, that's very interesting to unpack. So now we'll move on to kind of a different route. So obviously, the COVID-19 pandemic has been the top topic for pretty much a year and a half now. So how has the pandemic impacted the world of investment banking?
Gosh, what a great question. I will tell you, the pandemic has been such a such a paradigm shift, I would say, for investment banking. Some things stay the same with investment banking, but the way that deals are done, the way that deals are put together, the ways that investment bankers interact with clients have changed dramatically as a result of the pandemic. The technologies, I think, were always there in investment banking. Google Meets and video chats and video conference calls and digital data rooms and everything. A lot of those technologies were already in use in varying degrees in investment banking, but the pandemic, I would say, has accelerated their adoption. Deals now are being done virtually, are being done remotely over Zoom, like we're talking, right now. Management meetings between investment bankers and companies' management team meetings are often done virtually. Private equity funds are completing new rounds of capital, raising new capital commitments completely virtually with no in-person meetings. So the virtualization of investment banking, I think, is a new normal that we will see for the industry long term. I think you will see more remote work in investment banking. I think investment bankers will, many will clamor for kind of, maybe in the office for 3 days a week, but working virtually from home, for the remaining portion of the week. So virtual work has absolutely increased as a result of the pandemic, and I think a lot of that is here to stay. I think it's an open question whether, or I should say, how long term these changes will be. I'm in the camp of, I think there's some permanence to the pandemic for investment banking in terms of the type of work and how work is done. You see some CEOs of some of the bigger banks say, "Oh my gosh, we need in person. Get back in the office. We need to have this creativity and collegial environment and collaboration in an in-person setting." I think some of that will come back, particularly at the bigger shops. But I run a small boutique investment bank. I will tell you, I have not been in a physical office outside of my home for the past year. I've done, a whole bunch of transactions completely from my home office with my AirPods and earphones. Just negotiating deals, structuring deals, working with clients all over the world. And it's really, I think it's a beautiful thing. I think the pandemic has been extraordinarily challenging, and there's been a lot of suffering and tragedy that's come with the pandemic, as we all know. I think for the investment banking industry, while it's been challenging often to get deals done in this environment, I think a positive that can come away from it is you can see greater use of technology, better work-life balance, working from home, virtual work, that type of thing. So the pandemic has really had an effect, and it'll be interesting to see how the industry shakes out in the years ahead.
Kind of along the same note, speaking about these long-term trends that might completely change the industry, do you see the growth of AI and, automating a lot of these tasks? Do you see that putting the finance industry and specifically investment banking at risk of, job loss or reduction?
That's another really awesome question. My take on AI and machine learning for the financial services industry is this. I would say for finance roles that are essentially quantitative roles, where there's a heavy amount of automation. You'll see this a lot in quantum funds, quantitative hedge funds. I think sales and trading at a lot of the large investment banks have seen a lot of a lot of shift in technology and use of AI. I think for finance roles that have lots of replicable types of work that just are repeated over and over and over in large volumes, I believe that AI, machine learning, that realm that we're seeing now in terms of technology development, I think there's going to be a lot of disruption for those roles in finance. Replicable roles where you're doing lots of transactions, lots of things over and over and over, where each transaction is not too dissimilar from the next. AI will, I think, has a good probability of displacing a lot of those roles. By the way, it's already kind of happening at a lot of the large banks. Just knowing lots of people in the industry, you see technology really starting to come in, and you see a lot of like Silicon Valley engineer folks getting investment banking jobs because they're so good at the AI and the machine learning. And investment banks are like, well, why are we hiring a financial analyst when we can just hire an engineer and they can AI this thing to prominence. I would say, however, the qualifier is, I think for mergers and acquisitions, and for any finance role that is fundamentally rooted in delivering strategic and business advice to people, CEOs, CFOs, boards of directors, those types of finance roles, particularly in M&A, that involve judgment, discretion, advice, perspective, relationships, poise, deal maturity, deal poise, those are not really replicable. That is a seasoned, time-tested set of knowledge and experience that is cultivated over time that you can't really AI that out of the marketplace. It's, maybe someday someone will create a robot that has the judgment and deal maturity and perspective and relationships. I don't know what that would look like, frankly, but I would say in my business, which is mergers and acquisitions advisory, there is such a huge human component and communication component and discretion and judgment and timing and perspective that it's case by case every minute of the day. It's non-replicable. AI will have a tough. AI will very likely not displace that. And I still think there's there's a lot of extra room, runway for the M&A industry to grow without the use of AI over time. As for like financial modeling and Capital IQ and Bloomberg terminals and replicable tasks, spitting out LBO models, AI and machine learning on the edges will start to displace some of that grunt work that you see, that kind of very laborious, tedious work that's replicable over time. But the big advice giving, strategic business advice that comes with investment banking at the executive level, I think that's here to stay, despite what AI can offer.
So as a follow-up question, considering the generic kind of pathway that an investment banking career has, you start off as, if I'm not mistaken, as an analyst, right? So your job would be pulling all this data, creating models and that sort of stuff. So if that entry level is replaced with AI, then how would people just directly go to whatever the next level is, or is there a shift that's occurring right now which allows you to answer
Yeah,
that question?
yeah, I would say this. The industry will always have entry level investment banking jobs, analyst level investment banking jobs, the internships. Um, there is still, investment banks are run by human beings and need to be run by human beings. I think we'll be hard pressed one day to have a fully AI'd investment bank that is run by robots. There's a negligible probability of that happening. And so you will always have, entry level investment banking jobs that require, discretion, human judgment, some automation, around modeling and some of the replicable stuff. But there's also a mentoring component that comes with investment banking. The more senior investment bankers who have the relationships and years of experience want to bequeath that knowledge and perspective to junior bankers and bring them up the ranks so that they can one day advise, the senior executives and boards of directors of major companies. And so there's a knowledge transfer that needs to take place so that these firms can continue to exist and thrive. You need to have that in place. So I would say, I mean, I'll give you a quick example. When I started out as a first year analyst in investment banking at Goldman Sachs, all of the financial models that I did, I built from scratch. Day one, I was building them from scratch. Some models, were kind of used over and over, but like I really had to build models from scratch, and I had to go into the annual report of a particular issuer and look at the revenue statement and the balance sheet and type in manually into the keyboard, the financials, and then that would feed into the public comps and the merger model and the other elements of the modeling exercise. I would build all of it from scratch. 9 months later, that building from scratch piece of the equation was removed because a company called Capital IQ, which is now a household name in investment banking, suddenly Capital IQ had collated all of the financial statements digitally and virtually and electronically. And so you could literally, with a button, click Capital IQ model, and suddenly you'd have a fully fully integrated financial model, basic financial model, operating model of the issuer in your spreadsheet. And you go, aha, now I don't have to spend 12 hours going on, into the financial statement on my own to do it. That happened within 9 months. And there were further iterations of new technologies and new software and things that were happening all the time. So, and that was, goodness, 15 years ago. So there have been hundreds of new iterations of new technologies and automations happening since then. And banks are always trying to find creative ways to innovate and to increase efficiency in terms of giving advice and putting models together, et cetera. But and that's happening in real time as we speak. And it just goes to show you that technology is constantly evolving, and it's fun to see where it goes. But I will tell you, my advice to anyone on this chat today, my advice is to avoid the shortcuts when you're starting out. Avoid looking for the quick fix button that just does the homework for you. In an M&A transaction, it is vitally important to really understand the context of the numbers that you're looking at in the spreadsheet or in a model. It's so important to understand what's driving a transaction, what's driving a business, the key elements and drivers of a company. And clicking a button and just having the robot, the AI kind of do it for you. It may be quick and easy to do that, but you're not going to come away with a sound understanding of the fundamentals of the deal, and eventually that will catch up to you if you don't spend the hard hours, really understanding the bread and butter of an M&A deal. So I would encourage those of you who pick up financial modeling to do it the hard way when you start out. Do it with pencil and paper starting out. Do it with built from scratch models in Excel, where you are just doing everything manually, because that's going to make you more resilient over time as you get more technologies and automations in your desk. You'll have that kind of bedrock understanding of financial modeling and transactions that will stay you through those new innovations that come into the marketplace.
Thank you for the great advice. So that actually brings us to the end of our, prepared question section. So now we'll move on to the Q&A. So we have a couple pre-submitted questions, and then after that, we'll go to the live questions from the audience. So for this part of the meeting, I'll hand it over to Ben.
Thank you.
Yeah. So my name is Ben Luis, and I'll be doing the Q&A. So for our first pre-submitted question, we have one asking, what should I be doing at 16 years old besides starting a custodial Roth IRA and getting a credit card?
Yeah, well, I would say it's a smart question, and it's a great question to hear, because to be thinking about finance at age 16 and investing, already, full stop, you're on the right track. You're doing the smart thing. You're thinking about money, not in the sense of, well, how do I make a quick buck? How do I make a lot of money very quickly in the stock market or something? Forget that. I'm talking about finances, wealth creation, how money works. Thinking about that at age 16 I mean, you're already ahead of where I was at age 16. I wasn't thinking, had some jobs and stuff, but I wasn't thinking about, a Roth IRA and different investment vehicles and what have you. So I will tell you, it's reassuring to hear the question, because already you're off to a good start. I would say, in terms of, every person has their own, view on wealth creation and financial management. The key phrase I tell anyone to think about who's maybe in high school or early college years, the key phrase to keep in mind is the beauty of compounding interest, which tomes have been commented on this and written about with, the likes of Warren Buffett and seasoned investors who run big firms, Nobel laureates and what have you. But the power of compounding interest, compounding returns, is a powerful one. And so for anyone who has like a side job, if you're waiting tables, if you're caddying at the golf course, if you have an allowance or something, I would encourage everyone to take some percentage of whatever you earn and set it aside and put it in an investment account that will earn a rate of return for the long term. And you don't look at the investment, it will just sit there and compound interest or dividends over time and appreciate in value for the long term. Think about every paycheck, every payment that you get, set aside a certain amount. It could be 1% or 5% or maybe 20%, and set it aside for your investment portfolio. That is a really great thing, because you know what, that $1,000 or $100 at age 16, that's going to be $30,000 by the time you're 25 or 30, and by the time you're 50, it will be $200,000, depending on what asset class you're invested in. If you're in the stock market or stock or something, there's a higher probability you'll have greater appreciation if you're in something like, a municipal bond or fixed income instrument, a low rate of return. But regardless, your capital is going to compound over time and appreciate. And so I view anyone at the age of 16 to think about not necessarily the type of investment, it's just the step of every check you get, every payment you get, set a percentage aside, no matter what the amount, set it aside, put it in your brokerage account, open an E-Trade account or TD Ameritrade, one of these, brokerage accounts, and invest it in something. You could buy a stock, you could buy an ETF, a mutual fund, something like that, and set it there, and don't try to time the stock market or anything. Just set it there for the next 20, 30 years, and you'll have built something that is true wealth creation over time. And that's a very powerful thing. And so I think it's already laudable that you're thinking about finances and money at age 16. And I would say take the long view and just view it as a very disciplined thing of every paycheck, take an amount out, invest it, set it aside, don't look at it, and keep repeating that over time, and you'll build something pretty meaningful over time.
So you talk about paychecks at a young age, and for some people, they can't get jobs in high school. But would you say that there are internship opportunities for high schoolers who want to get into finance?
There can be internships opportunities for high schoolers who want to get into finance. I think I can't speak to the kind of paid versus non-paid internship. I think it just depends on who's doing the hiring, but there are opportunities to get involved. I would say, in high school, I wouldn't be so focused on quote unquote making money, in terms of like trying to, get that high paying investment banking internship in high school. There's a low chance of that really coming together. I would really focus your attention on the education of finance and really seeking out opportunities where you're work with smart people, have good mentors who will teach you important, bedrock principles about finance and money and wealth creation. It's important to have those, try to find those opportunities where it's more of an education, less of a, money-making endeavor per se, because in high school, typically the internships are unpaid. And even if they are paid, it's a pretty nominal amount typically at the high school level, just in terms of kind of level of experience, et cetera. but it's worth exploring. And that's why I will tell you what Streetfins is doing is really outstanding, you guys, because you are performing such a vital mission in terms of financial literacy and educating young adults about important features of finance, and the education that you get in high school, whether it's volunteering or a Streetfins event or some internship. That's a really great thing to be focused on. But I would leave the money making part to probably college and post college employment opportunities, and really focus more on the education when you're in high school. Again, whether through an internship or an event like Streetfins or otherwise.
Okay, so that will wrap it up for our pre-submitted questions. We're going to open up the mic for people who would like to unmute and ask you questions personally.
Great.
I think first we have Nathan.
Yeah. Can I ask you a question that's different from the one I submitted?
Sure.
That's fine.
Yeah, sure.
Totally fine.
Well, I guess you said that you studied like Asian studies in college. I was wondering, was there some sort of other education you did in order to prepare yourself for a job in investment banking, or did you take like a course or something? Or?
Yeah, it's a good question. So I mentioned I majored in East Asian studies. That was my main focus. Spent a year and a half in China. I took a lot of history courses, humanities courses, literature courses, art history, ancient Chinese history. I mean, like, I was a true quintessential liberal arts major. I mean, it was really a quintessential liberal arts experience for me. I did take a couple of classes as an undergrad that, in addition to the Chinese studies, kind of got me interested. I took a course. It's kind of interesting timing. It was in 2000, and I think it was 2005, 2006. But I took a course at Princeton called The History of Financial Crises. And this was like a year and a half before, of course, the great financial crisis. And I took a course on the history of financial crises. And it was a seminar, and it met like 13, 14 times. Taught by a wonderful professor, Harold James, who still teaches at Princeton. Wonderful professor. And we went through different major financial crises over history in England and Argentina and the US, and the great stock market crash of the 1930s. And dissected all of the financial crises and what caused it, what came out of it, how did the regulate. And I was like, gosh, this is so cool. And I don't have a big finance or quant background, but this economic stuff and financial crisis, this is like really cool. And how do central banks respond to financial crises and put out the fires and what have you? And so I took that class, and that was pretty cool. And I took one or two other classes that had they weren't like econometrics or like some heavy finance class, but they touched on economics and finance almost from a historical lens. And that really piqued my interest. And so it was a natural, it seemed like a natural step for me to work at a bigger, a big-ish investment bank for my first job out of college.
Thanks.
Okay.
Thank you.
Our next person was Arushi.
Oh, can you guys hear me?
Yes. Hi, Rushi.
Oh, I lost it. I can't hear you. But if you guys can, give me 1 minute.
That's okay.
We'll come back to you.
Okay.
Would Nicholas like to ask their question?
Yeah. So thank you for this opportunity, Mr. Willard. You said about your experience with East Asia and China. So considering the potential decrease in deal flow due to rising interest rates and taxes, decrease in valuation of the dollar, and poor U.S.-China relations in lieu of the Anchorage summit, what's the outlook for firms that specialize in cross-border Asian transactions? Is a global economic shift realistic, or our current skepticism simply cyclical and over-exaggerated?
Wow, Nicholas, I wish you were at my strategy meetings at 52 Capital Partners, because oh gosh, I wrestle with this question all of the time, because we specialize in advising a lot of U.S. companies on cross-border transactions with a nexus to China. I will tell you, and you alluded to it, the Anchorage Summit is the recent kind of blow up in the relationship. It has been a very challenging market for cross-border deal making with China. the past few years. The tariffs, the trade war of the prior administration, concerns around the South China Sea, geopolitical tensions, concerns around Hong Kong's future, the protests in Hong Kong. It's a tough environment right now for getting deals done with China. And I would say, the new administration in the US is kind of, continuing some of that kind of hard-edged approach to China, kind of hitting China over things like human rights in Hong Kong and Taiwan, et cetera. And so I would say there is a high probability we will see a continued difficulty in cross-border deal making. Deals are still getting done, Nicholas. Deals will always happen here and there, but in terms of the regulatory environment, like CFIUS, the Committee on Foreign Investment in the United States, that reviews foreign, transactions involving U.S. companies, CFIUS review will continue to be high. The FIRMA, regulatory regime is in place that is very robust, and I think we'll continue to see heightened review and scrutiny of, sensitive sectors like, AI and software and technology transactions that are happening. You'll see a lot of block deals continuing to happen. So I don't think we're out of the woods yet, Nicholas. It's something I wish we were out of the woods, by the way. I wish we had more strategic engagement and better relations with China, because it allows for our economies to interact in a healthy way, and we have greater prosperity, more interactions, more deal making, more investment. That's a positive thing. It helps confidence in our economies. But we're not out of the woods. I think there's a high probability we'll continue to see some deterioration. I think the interesting thing, I had a call earlier today with a colleague who's in the energy industry, and I was saying, I wonder if what's happening in Hong Kong is a precursor to what might happen with Taiwan. So I think the new potential flashpoint in the relationship, we'll see how it shakes out, is the situation with Taiwan. I think a lot of people are wondering whether what's happened in Hong Kong is a precursor to what'll happen in Taiwan. So you're getting a lot of attention right now in the policymaking community directed towards Taiwan and the South China Sea and China's movements in the South China Sea. So it's really unclear how this shakes out. I mean, I hope relations improve. I hope we can get back to doing more deals in China, but for the time being, it's still very challenging.
Okay, thank you.
Thank you.
Okay, so we have Arushi, if they were able to get their audio working.
Yeah, hi. Can you guys hear me?
Yes.
Okay, thank you. First off, I wanted to thank you. This is a really awesome talk, and I really enjoyed hearing about investment banking. And I think you were talking about, you were alluding to talking about like financial models, and I wanted to ask what the purpose of a financial model is.
Sure. Great question. A financial model, that is the engineering, the bread and butter making, the fundamental bedrock of financial analysis. It is the means by which investment bankers assess the prospects of an M&A transaction. So in a financial model, typically you'll have an investment banker put together a fully integrated financial model that includes the income statement, balance sheet, and cash flow statement of a particular company, say a target company that the investment banker's client is looking to acquire. And the financial model will have both historical financial data and information on the company, how the company's performed for, say, the past 5 to 10 years. And the model will have basic assumptions about the future performance, prospective performance of the company, its revenues, its margins, key ratios and metrics, how its capital structure will evolve over time. And again, the investment banker will use that financial model to often put together a presentation that synthesizes key aspects of the financial model that they can present to the client to say, hey, look, this target company has EBITDA margins of 60% and revenue growth of 30%. And based upon that fact pattern and profile, we think this is a great transaction for your company to pursue, highly accretive to your business. The financial model, has some basic assumptions that we're making, obviously, but this is a great deal for you to pursue. And the financial model will be that kind of operating table where the investment banker will, perform surgery on, the financials of the target company to assess whether it's a good deal to make. So if you're starting out in an internship in investment banking or a first-year investment banking role out of college, financial modeling is the bread and butter that you'll be doing day to day, and it's really important to get it right and to have that, what I was saying earlier, to have that raw experience making those models from scratch, so you really understand how transactions are assessed and put together.
Thank you.
Thank you.
Okay, so we're going to have 2 more questions. Next, we will have Andrew, and then after him, we will have Jen.
Hey, thank you very much for the talk. Super interesting. And I know that you went to Princeton University, and obviously that's a pretty well-known and prestigious university. So my question was, how much impact does the place where you go to get your college education have on getting into investment banking? I know there's target schools, but how much personally, how much do you think it has an impact?
Yeah, I would say it has less of an impact than you would think, and increasingly over the years, where you go to college doesn't mean much of anything. I think investment banks these days are looking for enthusiasm and excitement around the profession and commitment to the profession. And whether you're at a state school or a community college or a public school, private university, a liberal arts school, international school, name your conference in the U.S., a D1 school, a D3 school, something in between. Investment banks are just looking for intellectually curious people who are smart and want to take a crack at the industry to see if they can make it into something, and they're looking for that commitment and excitement. I think it precedes our time, but I think perhaps generations ago, the old Wall Street of kind of a bygone era maybe took into account brand schools a bit more than these days. But I would say it is wide open. It really it is wide open. I have friends in investment banking who are very successful, who come from all manner of schools, and really well-known schools, less well-known schools I'd never even heard of before meeting them, and they get into finance and they're very successful and have very rewarding careers. So I would not have brand of school serve as any sort of deterrent to getting into the industry. There is no litmus test that investment banks impose in the hiring process. I think they're just looking for smart people who are intellectually curious and excited about, again, pursuing the profession for some period of time, and that's the main threshold, the main test that they're focused on.
Okay, thank you.
Yeah.
And then next we have Jen, and sorry if I'm mispronouncing your name.
That's fine, it's pronounced Gyan, but okay. Thank you for your presentation, Mr. Willard. You said that one of the last things you said was that if you put your money away right now, in a few decades, it'll become much larger, right? So does that happen? Like, say I put $1,000 away, right? It'll become into something greater, but do I need to continuously invest? Do I need to continuously invest in that, or continuously put a small amount of money in that every month or every year to see more gains, or just?
Yeah, I would say if you can, I read a great quote the other day. A great quote. If I can dig it up, I'll send it to the Streetfin guys afterwards. But excellence is not an act, but it's a habit. Excellence is a habit. It's not a one-off. Oh, I picked some stock and put in $1,000 and now I'm good. Success in investing rarely works out that way. Investing involves discipline and habitual investment of time and capital into wealth creation. And so I would say if you can make little bits of investment on a regular basis, almost automated, if you have if you at a job, you get a paycheck every week or something, make it so that every week, every paycheck, you put 10 or 15% of that into your investments. And if you do that, if you repeat that process every single time in a very habitual way, in a disciplined way, suddenly, after a year, you don't just have $1,000 and maybe a little bit of appreciation because the stock price of some stock has gone up or whatever. You've got $5,000 because every week, every pay, you have socked away some amount into, finance, into an investment. And that grows over time. Earlier in my career, kind of earlier on, paychecks will come out every 2 weeks. I had automated in my account so that every paycheck, I didn't even have control over it. Every paycheck, $250 would go into my E-Trade account, which I would then invest in like an ETF or something like that every single time. So it's like I would go to sleep at night just fully recognizing that after every paycheck, there was going to be some portion of it devoted to investing. Now, you're sacrificing near-term gratification by investing, because by taking that $1,000 and putting it away, you're not buying your new Nintendo 6 or your scooter or your moped or your whatever you want, your new iPhone or whatever. You're making a sacrifice, but it's a really worthy investment, because that $1,000 in 10 years will be $10,000. And then if you add to it every month habitually over time, that just, all of those investments compound over time. And so, after 10, 20, 30 years, you've built yourself, a really nice nest egg, which is really powerful. But it takes discipline. This is not, you should not think of investing as like, ooh, let me find someone, on CNBC who's got some, one of these talk show guys who's got a really good company that he thinks is going to go through the roof. And let me just put in $100 there, and then I'll be set for life. Just don't think of finance or wealth creation that way. The best wealth creators, the best investors are habitual investors that do it regularly over time, like just almost automatic. And that compounds interest over time and can lead to true wealth creation. And that would be my biggest advice for you. And again, I have been very disciplined in my time, because I've tried to adopt that philosophy of just regular investing, just every week, just like hitting a golf ball at the range. Okay, I'm gonna go out to practice, hit a golf ball, invest a bit. Almost view it as like going to the gym. Well, I went to the gym today, I'm going to invest $50 into my brokerage account. I did my monthly check-in call with my parents or grandparents or something. I'm going to invest $500 in my E-Trade account. And you just do that like automatic. And you'll be really well set for financial success long-term in your career.
Okay.
Thank you.
I think that is the end of people who requested to do questions. So I will pass it off to Rahul, and then we will end it there.
Yeah, thank you to everybody who asked questions. Thank you to Mr. Willard for answering everything. If anybody else has any last questions, feel free to drop them in the chat or ask them right now. I know some people joined maybe a little later, so if you guys do have questions, please feel free to ask. If not, then we'll just get moving on. Okay, Dia, I think you have a question.
Hi, yeah, I joined a little late, but obviously the conversation is super interesting. So I had a question more about the culture of investment banking. So I know it's obviously very male dominated, and so I was wondering if you had experienced any like culture changes and such.
Yeah, Dia, it's an excellent question. I would say in the long sweep of history, investment banking, the culture of investment banking has improved dramatically in terms of diversity, women representation, minority representation. It is highly international in investment banking these days. And so compared to say 40, 50 years ago, oh my gosh, investment banks are so different in a very positive way from where investment banks were 40, 50 years ago, which to your point, I think were largely male dominated, and you didn't see a lot of women in high up positions. So you didn't see a lot of minorities or international folks in high up positions. And today that is dramatically changed. I'm fortunate to have friends, men and women of virtually every ethnicity, race, background, obviously female colleagues, people in high up positions and investment banks, around the world. And it's a testament to, I think, how the industry has evolved over time in such a positive way. I think there's still improvement that can be done. It's not like a light switch, you click it on and suddenly investment banking is fixed. You have to constantly invest time and effort into hiring talent and hiring women and hiring minorities, and really making it a dedicated effort, because you can't just turn it off. You have to stay true to it. And so investment banks need to be vigilant around that. But I do think that it's been a positive shift. Over the long sweep of history, the industry has really evolved in a positive way. And now these multinational investment banks, they are highly diverse institutions with people from every walk of life and background, socioeconomic, ethnicity, et cetera. It's really something, and it's really great for the industry. I hope that continues. And I hope, frankly, you see it at some of the smaller investment, the kind of the mid-market investment banks that maybe don't have as big a profile. I think that's probably the next phase of evolution in the industry, is having the kind of mid-tier investment banks make bigger inroads around diversity and women representation. So, but it's a great question.
And thank you, Mr. Willard.
Thank you.
Yeah. Okay. So in the interest of time, I think we'll just take it from here. If you guys do have any questions, feel free to email me, and then I can maybe send them on to Mr. Willard, and I'll let you know what the response is. So if you guys do have any questions, just send it to me instead of asking right now, and we'll make sure those questions do get answered. So it would be great if we could all just kind of take a picture right now for our social medias. So I'll count down, right? 3, 2, 1, and then after that, I'll take a quick picture. I'll take another one too in case you guys miss out on this one. So first one, here we go. 3, 2, 1. Awesome. And now another one for anybody who was unfortunately not prepared. All right. 3, 2, 1. Awesome. Thank you very much for everybody who turned on their cameras, for everybody who participated in this meeting, and just for being here, right? So before we close out this event, there's just some small things that we need to get through, right? So I was talking about all the resources that we offer. And, if you enjoyed this, you're definitely going to enjoy all the resources that we have. So we have a weekly newsletter that's a recap of the financial news and just gives you a good understanding of what's going on. So if you want to subscribe to that, streetfins.substack.com. Podcast, right? Like I mentioned before, the Streetfins Finance Simplified podcast is everywhere you can think of. So just search that up and you'll definitely find us. It's hosted by our founder, Rohan Gupta. Articles, head over to the main website to read all the latest news, right? So streetfins.com covers pretty much everything. So, just imagine Bloomberg, CNBC, Wall Street Journal, all of that. If you ever read that and you think, I don't understand half the words in here, then the correct place to come is streetfins.com, because we cut out all the, heavy lingo and just kind of give the facts, and that gives everybody a really decent understanding, even if they don't know too much about the industry, right? So it's a great place to get started and get a better understanding of what's going on. So if you enjoyed this event, then we have 2 more events coming up, actually. So if you were here at last week's event, you know that we're celebrating what is this, Financial Literacy Month by having a speaker every Wednesday, right? So that's pretty great stuff that's going on. Next Wednesday at 3 p.m. PST, we have Personal Finance Fundamentals with Miss Tanya Van Court. She's the founder of Goal Setter, which is a great company and app that is trying to teach kids about personal financial literacy, right? So make sure to sign up for that using the link right there. It's kind of long, so the easier way is to just go to our Instagram at Streetfins, and then the link is in the bio. We also have discussion with Boeing CIO the Wednesday after that, so 428 at 1 p.m. PST. So it might be difficult for some people on the West Coast, but this is hosted by one of our member clubs in Chicago. So their time, so we had to kind of adapt with that. So CIO Andrew Ward, so he's a great guy as well. Lots of insights that he's going to provide. So please do make sure to sign up for these great opportunities. It's not every day that you have such great things going on. So that's also in the same link. It's just a link tree. So you can sign up for all the remaining events that we have in this month by just heading to our bio. So yeah. Thank you very much. Like I said, if you have any questions, you can stick around and ask me and Ben. Otherwise, just send it to me in an email. Make sure to check out Streetfins and all the places I mentioned so far. And yeah, thank you guys. Thank you very much.
Thank you. Take care.
Thank you.
You too.
Thank you.
Bye.
Good day, everybody.
Good day.
Rahul, I had a quick question.
Yeah, sure.
Yeah, sure.
Is the Streetfin application like to be on the team still open?
Yeah, that should be open. That's also, there's another link in the bio, so just go to the link. It has a link tree within which there are a lot of other link trees. So if you just search up at Streetfins on Instagram, you should have access to all of those things. So yeah, definitely do check it out. We have lots of opportunities for everybody who's interested in any side of this, right? So if you want to write articles, if you want to help out with the podcast, if you want to produce social media posts, if you want to work with me and Ben on the club side, there's just a lot of places where you can fit in. So yeah, we'll definitely just sign up and you can figure out what you want to do, right? So link in bio is the answer to your question.
Thank you.
Feel free to message us if you're in the Discord. We're at the top under the staff section, I believe. So
Okay, yeah, will do.
just there.
Thank you.
No problem. Have a good day. Dia and Joseph?
Yeah, so I actually had a question about you guys. I came to know of this from our class Facebook. I think someone posted it. And so I was just like wondering about you guys, who you guys are and like that type of stuff.
Well, who are you? Because I don't know what school you go to.
Oh, I go to American.
Oh yeah, perfect. So I've actually been trying to get into your school, right? So my name is Rahul Rangaraj. You can see right there, right? I'm a student at Mission San Jose High School, so pretty close by. We're basically, so the Streetfins organization is a big financial literacy organization, right? And we have two parts, which is the content side and the club side. Content side creates everything I just talked about. Club side hosts these guest speaker events, investing competitions, networking opportunities, our great Discord server, and a bunch of other stuff that's yet to happen, right? So basically, we connect high school investment clubs from all across the country and pretty much the world now. We have a couple international clubs as well. So basically, we connect all these people and use this huge, we use all these people to really just provide these events. If you are interested in starting an investment club at your school, that would be great. So obviously, it's late in the year, but next year, over summer, we'll be getting in touch with people who we think can start these clubs. So if you would be interested in that, just send me an email. I'll drop my email right here. Please don't send the email to what you got this link from, right? Because that's the club email. I barely check that. So just send an email to that and we can get you sorted out. Like I was telling Jan, if there's other places where you want to get involved, that's also pretty cool. So just lots of opportunities, lots of stuff for you to do.
Awesome. Thank you.
Yep, no problem.
Bye, guys.
Yep, bye. Joseph?
Oh, I just wanted to
Yo,
say,
press.
Ben, I'm a big fan, and I love you, Ben.
I love you too, Joe. You need to come to jiu-jitsu.
I'll come to an open mat.
Okay. Goodbye, Mr. Goonie.
All right, see ya. I'm gonna get that LinkedIn connection.
Bye, Joe.
All right, that was